In CashCalc, we have two cash flow modelers, a net modeler and a gross modeler. The net version is the simpler of the two, and although it has some basic tax logic built in for pension income, in the main it expects all inputs to be added net of tax and won't run any tax calculations. The gross modeler, however, has been fully designed around the Irish tax system, and users can input everything in gross, and the model will do all of the heavy lifting, providing granular breakdowns on the amount of tax paid and illustrating the full impact of taxes on your cash flow. The net modeler is useful for basic cash flows and for offshore clients where you need all results to ignore the Irish tax rules, whilst gross should be the default for most cash flows in Ireland. And this video will explore the core differences and what makes the gross cash flow more sophisticated. So let's navigate into CashCalc. There's all of my clients. So let's select Sherlock and Edith. If we click on the info tab at the very top here, this is all of the data that I've managed to source for these clients. There's their investments, there's their pensions, there's their incomes, there's their expenses, etc. How have I got this data into CashCalc? Was a couple of ways. I can manually add line by line just by clicking the add button. I can get the client to log into their portal, which is this. So once the client logs into the portal, one of the first things they can do is run a fact find. So the fact find allows them to add all the necessary information that I need to run cash flows, employment details, incomes, expenses, pensions, etc. Or we have got various different integrations with third parties that you can pull the data on the fly via an API. But once I've got the data into CashCalc, I can just simply hit that update a calculator button. I can give it a name, something like test, and I can then opt whether I want to run a net cash flow or a gross cash flow. If I select gross, it will then add all of the necessary bits of information that it already has, and I can click on export, and it throws that into my cash flow and creates one on the fly. Alternatively, if I just simply click on the cash flow tab at the very top here, you can very quickly flip between all the cash flows that you've created in the past. So these are all the cash flows I've created net, and these are all the gross cash flows I've created. Each time I create a new cash flow, it always allows me to opt between, again, net and gross. So again, I'm going to call this one test at the very top. We can decide whether we want to do a blank forecast, so a blank canvas where we just build from the ground upwards. We can clone from an existing forecast. So I already had one gross cash flow, so I do want to just simply clone it and adjust it. Or the third option is I've got all of that information sitting there back in my info tab from all the fact find data and all the integrations I've got. And there it all is. There's all the information I've sourced for that client. And I can now just simply hit the create button, and all of that data will go straight into a cash flow. It's opened up the cash flow tab at the top. Welcome to the gross cash flow model. It looks a little different. And if we go to the cash flow model on the left, there's the money in, money out automatically created. There's the savings over time. And there's all of the taxes based on all of these inputs that I've not had to input myself: the pension, the income, the expense, etc. To delete a cash flow, you can just simply click on that little cross icon, and let's go back to the current position. And let's start with this. Let's explain the gross cash flow modeler using this particular example. So as I said, welcome to the gross cash flow modeler. It looks a bit different to the net in terms of the UI and the way you navigate yourself through this. Ultimately, there are 5 options on the left-hand side, and each one of those obviously change what you've got on the right. So inputs and timeline is probably the most important. They're all your inputs. So we'll work our way through each one of these one by one and show you how it differs to the net. Under assumptions, very similar to the net modeler, you can decide when the forecast ends or how much inflation you're going to be taking into account on the forecast. Like the net modeler, you can determine how much of the surplus income is saved, 0% up to 100%. And that's obviously then in the net modeler defaults to be put into the current account. The difference with the gross modeler is you can opt for any of that surplus income to be added to a different account. So let's just explain that in a bit more detail. At the moment, if I go to my cash flow model and go back to savings over time, actually let's start with money in, money out. You'll see in these early years in particular, this is the dark expense line there. There's quite a lot of income that goes over that expense, meaning there's a lot of surplus income in these early years. And what happens to that surplus income? Well, ultimately, the surplus income ends up in the current account because there's nowhere else to put it. So under savings over time, you can just about see that play out. These little tabs over here, you can see it swelling. And a lot of cash flows you'll create will bloat quite heavily because there will be a lot of surplus income, particularly in early years, where realistically, although there is technically a surplus, realistically there isn't a surplus, because if there's any surplus income in my account, it generally tends to get spent on holidays and children and just living. So what you can do on cash flow is, rather than having to net out that surplus by going and adding in an extra expense, I can simply use that logic here and say, no, instead of saving 100%, save 0% or 50%, whatever you like. And that will update my cash flow. I can go back to my cash flow model And you can see that's automatically updated. All that surplus income has been netted out. It's disappeared. So it's just assuming we've spent it. And the cash flow's now got a little bit more negative than what it was before. But incidentally, what you could do is say, well, actually, yes, the client is now committed to maybe save only 10% of that. So 90% of it gets spent. But we want to save that to maybe the Irish Life pension. And once that's done, if we come back to my cash flow model, we can see that the surplus income, the 10% of that would be put into this pension pot. And if we go to the yearly breakdown tab, certainly in one of these earlier years, if we look at the liquid assets, if we go down into my Irish Life pension, you can see, there we go, the income surplus is being recorded in there for us. So that's quite a neat little feature. I'm just going to set that back to 0. So we're not going to save any surplus income. So as I said, the main difference there between gross and net, the net allows you to obviously turn that from 0 to 100% anywhere in between. The gross model allows you to redirect some or all of that into a slightly different pot. What about peoples and timeline? That's changed quite a lot compared to the gross. We need to know how much tax-free lump sum has been used before the forecast starts, so we can tally that together for you. The clients have been separated as well, Sherlock and Edith, side by side. You can change pension access age for both of them if necessary. You've also got full medical card holder tab for each one of them as well, so it reduces the USC rates. You can also signal that they're married or in civil partnership, and therefore what tax assessment type do you want to use, joint, separate, or assessment of single persons. If you do use joint assessment, it will automatically optimize the standard band allocation each cash flow year for you. If you don't want that for whatever reason, you can deselect that and choose your own percentage. Timeline feature is also very useful, also available on the net modeler, but we'll cover that off at the very end. That's not really much different. Savings and investments is very different in the gross modeler because you can basically label different pots, and obviously different pots will have different tax treatments. So when you add a savings or investment pot in gross, give it a description, then you categorize it. Obviously, if it's cash, that's going to be the dirt tax taken. Direct investment account would be CGT, insurance bonds and UCITS would be deemed disposal and exit tax. Or if you want a pot that doesn't have any tax implications, you can select that last one. But each one you select will vary the inputs just ever so slightly, depending on what you've selected. It usually will expect you to put an owner. Is it Sherlock? Is it owned by Edith? Is it jointly owned? Again, that will alter the tax treatment accordingly. Original investment, a lot of these pots will expect you to say how much has been invested in total to date and how much the pot is worth today. So we know how much gain there's been made, particularly for capital gains. Then a return, every pot is expecting you to type in a particular return rate. So maybe we expect this to grow at 5%. You can either do a deterministic percentage, or if you click on template, you can select either one that you've built in CashCalc already, or quite a popular option would be to select a portfolio you've pulled across from Analytics, our other application. So maybe I've got the dimensional world allocation, or I've built a portfolio in Analytics. I can pull that across into CashCalc. I can select it here, and based on the asset allocation today, it's telling you what we think the linear growth rate should be, and we'll be using 4.9 going forward. So it just saves you a bit of time, perhaps a little bit more compliant. Some of these pots as well, dependent on what it is, will obviously give you the option of adding in interest or dividends as well. So yes, we expect this pot to grow at 4.9%, but maybe 2% of that, or 2% is going to be interest, 2% is going to be dividend. You can do both of them, and you can determine how much of either an amount or a percentage, and then you can determine if it's going to be reinvested back into the pot, or whether it's going to simply be put into my current account. So that's adding different investment pots, or just different pots of money. Also, you can set different liquidation orders as well. If you've put in a specific withdrawal, then it's going to explicitly take money from a particular pot from a date to another date. If you don't add any withdrawals, essentially what it will do is it will take in this order. So if I go back to my cash flow model, look at the savings over time, you can see that the first pot it takes is the Davy investment account. Then once that's exhausted, it's taking it from the ETF. And then once that's exhausted, it's taking it from the cash account, and the pension essentially never gets spent. You can alter that logic though. If you can do this on the net as well. It's a slightly different functionality. You just click on that set liquidation order, and you can essentially drag things up and down, or you can just move pots up and down here, and it will automatically adjust on the cash flow. So that's savings, investment pots, pensions. Few differences here. On the net modeler, you can add a state pension. You can do that with the gross as well. It will automatically default the correct fields, so I can specify whether it's Sherlock or Edith. Depending on who I select, the right start and end dates will pop up, and obviously the correct value. Obviously, you can adjust that if it's not. Come back to the main screen. The big difference is the DC pension, the standard pension. So I can tell the system that this is maybe an Irish Life pension. It's owned by Sherlock or Edith. Starting pot value is maybe 700,000, and I can tell the system whether it's already ARF or vested PRSA, so the existing lump sum has been taken already, and I can add in some imputed distributions myself, or actually no, it's not in drawdown at the moment, but it will be in drawdown soon enough. So you can specify when it's going to be coming into drawdown, essentially when that client retires, how much lump sum to take, defaults to 25%, and then you can add in the minimum imputed distribution withdrawal, so that will add in the 4 and 5% for you, or you can actually specify your own amount. Maybe that client wants to take 8% a year. You can do that there. And again, same as any other pot, you can specify a particular growth rate. Once you've added those in, if you click on the withdrawals tab, it will show you the line items that have been added for you. So the client's got an Irish life pension that's due to go into drawdown when he's 65, when he retires. So automatically it's added these 3 line items for you. The Irish life pension at 25% tax-free, 4% imputed, and 5% imputed distribution at the correct ages. Incidentally, you can add them very quickly at the very top there. So if you did want to add them manually, you can add the tax-free lump sum and the imputed distributions. And again, most of the fields are pre-populated for you, so it saves you a bit of time, or you can add any kind of generic withdrawal from any pot just by clicking add withdrawal. So that's pensions. Also, incomes are very different from the gross to the net, as you'd expect, because of the tax treatment of the income. So when you add a brand new income onto the gross modeler, you've got a signpost whether it's employment or other income. If it's other income, it's either going to be taxable or non-taxable. If it's taxable, it's either earned income or dividend income. We clearly need to know that. Under employment, again, who's the owner of this employment income? If it's Sherlock, give it a description. Maybe it's salary, and then it's either going to be employed, self-employed, or company director. So again, you've got to signal which one of those it is. Maybe it's employed and he's making 60,000 a year. You can also signpost whether it's part-time working, so proportion of full-time working hours there as a percentage. You can also specify any bonuses the client's getting, any benefits in kind, also set from a date to another date. You've got income change as well, which is neat, which is very different to the net modeler. In the net modeler, if there's a change in someone's income in the future, you have to set up 2 different salaries. It's a bit of a faff, but in here you can click on add income change, and suddenly I've got gross salary 1, which might be 60,000 for another couple of years, and for the 2 years leading up to retirement, maybe that he's going to take part-time and it's going to be 30,000. So that will automatically adjust as just one salary. And also at the very end here, you can add pension contributions automatically as well. So I can select pension contributions from salary and or bonus. I can tell it where to put those contributions into the Irish life pension in this case. And I want to put a percentage of maybe 6%, and then I can add an employer contribution of 6% as well. Once that's added, if I come down to the contributions tab on the main screen down here, that will be automatically added there. So again, this is just automatically added, the 6% in salary going in as the employer and the employee. So again, itemized separately. So that's incomes. Tax credits are again new for gross, not available for net. So you can add in your own tax credits manually up here. All the different tax credits are there, so you can select any one of them. It will pull through all the necessary information. You can put a start date and end date, who the owner of that tax credit is, and again, that will impact the tax calculations underneath. And we have got a few quick adds though. If you click on quick add at the very top here, certainly the most popular ones are these ones. So I can click on any one of these, and again, it will pre-populate all the relevant fields, correct start date and end date and the amounts, and I can just simply add that in myself. We'll have a look at how that affects the calculations in a second. Expenses, there aren't that much difference in gross and net. The only difference is you can label them differently. So under expenses, I can label them as lifestyle, essential, or discretionary. The big difference, the logic is that essential would be just heating and eating, your basic expenses to cover off life, your energy costs, food, motoring, the boring stuff, house maintenance. Then the lifestyle expenses, they're the things that you'll then spend to actually give you a comfortable, nice life, your holidays and your socializing, etc. And then you've also got maybe discretionary spend, like child's wedding, and the fact that it's a 15,000 euro one-off coming in a few years. So that's bank of mum and dad paying for that, and then the 40th wedding anniversary coming in a few years as well. We've labeled that 20,000 discretionary. But when you add any expense on here, you can signpost whether it's essential, lifestyle, or discretionary. What that means on the actual cash flow, if we come back to the cash flow on the left-hand side, when you go into money in, money out, you've got the lines separately listed for essential, lifestyle, discretionary, and total. So if I just hide all of them, this is quite a neat little feature. or hide everything and just simply look firstly at essential. So these are the essential expenses you need every single year, Mr. or Mrs. Client, about 17,000 euros a year. That's what the lifestyle expenses on top is. So that delta is basically a pretty boring life to a very good life. Then the total expenses on top is all three of them. So it shoots up every now and again for those discretionary spends. And then we can start adding in everything else. So this is what it looks like when you start adding your two salaries in. Mr. or Mrs. Client, this is the interest you're getting from your cash account. There's your Davy dividends. There's your tax-free lump sum coming in and your imputed distributions and your state pensions and your ETFs. There's your Davy investment account, ETF cash savings account, and your insurance bond at the very end there. And that's what creates all of the income necessary to meet all of those expenses. So a little bit more detailed than the net modeler. Transfers is quite a useful feature. Again, you don't get this on the net version. Essentially, just allows you to transfer very quickly from one pot to the other. Again, it's a bit fiddly on the net version. You have to set a withdrawal from one pot to the current account and then set a contribution from the current account into another pot. So again, you can do it, but like with most things in gross, it just makes your life a little easier. So I can click on add transfer. Instead of fiddling around with contributions and withdrawals, I can just simply say, look, my client is going to be regularly putting money from maybe that cash account that's getting a little bloated, and we're going to start gradually drip feeding that into my investment ETF. I can call that whatever I like, however much, whether it's a one-off or per year. And then click on add transfer and it will do all of the necessary transfers in the background. Or maybe my client's in a balanced solution now, and in a few years I want to move them to a more cautious solution. Again, rather than having to create two pots and then again quite fiddly adding contributions and withdrawals to move that all across, I can just simply say from one pot to the other on a particular date, essentially move 100% of that pot from one to the other. So you'll find over time as you use the gross more, that transfer feature will come in quite useful. Contributions we've already covered off. Obviously, everything I'm adding in these inputs, whether it's a pension contribution or whether I'm suggesting that I want all of the income generated from a cash account to feed back into the cash account, you've got it all automatically here. So I've got my Davy investment account paying 2% in dividends or interest, and that's going straight into the current account. This cash savings account pays a 3% income, but that's automatically getting invested back into the cash savings account. So again, all of these have been added automatically for me based on my previous inputs. But if I wanted to add any contribution manually, I can do just by clicking add contribution and saying where the contribution is coming from, if it's personal contribution or it's coming from an external source outside of the cash flow, and again, how much from a date to another. Withdrawals, again, we've covered that off. You've got the quick adds there. And then costs and purchases at the bottom, very almost identical to net. You can add any charges you like, maybe like an advisor fee or a service fee or maybe a fund charge. Quick add would be annuity purchase. So when the client retires, they expect to take this pot, sell it down for an annuity, and then each year or each month they're going to get X amount of income coming in. It's going to be level or index. And again, the moment the income hits the cash flow, we know what tax to take. So that's all the inputs, obviously very different to the net modeler. The cash flow is quite different, as we've already shown. You've got the money in, money out. You've got the savings over time, which again, admittedly, are pretty identical to the net modeler. The taxes is the big difference. So all of the taxes that client is paying has been automatically calculated for you. So you can see year on year how much the client has got, in this case, in terms of Sherlock's income tax. You've got the USC, the PRSI there as well. Again, you can turn them on and off here, so you can very quickly see Sherlock's got some CGT liability there. It comes from their investment account when they start taking money from there. The dirt money they're paying for their cash. You've got exit tax as well. You can see because the deemed disposal, it's quite lumpy. Every 8 years, you suddenly get a higher fee, so that it's not just the exit tax, but also the deemed disposal. And you've got EDIS, CGT, and exit taxes in USC as well every single year of that cash flow. For more granular detail, again, there you can always go down to yearly breakdown. You can click on any one of these breakdown tabs, and you can see here, if we go into money in on the left-hand side, there's Sherlock's salary, 70,000 coming in. There's the employee pension contributions we've recorded. That's the taxable earnings, therefore. Income tax paying 13,000 euros, USC, PRSI. So that's the net amount Sherlock receives. There's the income tax calculation. So every single time there's any income paid in, any tax related to that will be fully disclosed underneath it. There's the interest being paid from the cash account. So there's the dirt paid and the calculation there. There's the dividends being paid from the Davy investment account. So again, that's a jointly held account. So it's itemized separately for Sherlock and Edith. And again, they're based on their bands and credits. That's Judith's salary as well, and their ETF investment dividends as well coming in, and the exit tax. Edith is paying for that. And you've got some CGT as well, so the ad hoc withdrawal from Davy investment account. There's the capital gains calculation. In fact, there isn't any capital gains tax to pay because they're being used. The annual exemption amount is being used. So everything's fully recorded on CashCalc each year. Money out is just the expenses every single year. Again, quite similar to net. Liquid assets is just the pots of money and all the money going in and out. So we've got the Davy investment account, the ETF, Zurich insurance bond, and the pension. You can see the surplus again going in there, and the employer contribution and the employee contribution being recorded separately as well. If I go to a year that was, I think there was a deemed disposal in here. If we go back to liquid assets, you can see for the Zurich insurance bond, that's where the exit tax on deemed disposal is signposted. So again, we're not taking any money from the Zurich insurance bond, but there is a deemed disposal, so it's being removed from that bond. And again, it's all recorded. Every single year has got this people tab as well. So any tax-free lump sum that's being taken is recorded. So it's showing you the percentage left that's eligible for tax-free. And then anything out of the ordinary that's happened this year is recorded under insights. So that would be, again, exit tax on deemed disposal, distribution, or pension being crystallized, etc. So that's quite useful as well. If we ever want to make any changes to our cash flow, just very quickly, this is where the timeline feature comes in quite useful. If I create a duplicate cash flow, so that's what this button is there for, I can click on that little plus icon. I can call this duplicate. Actually, let's call this something a little bit more relatable. Retire early, question mark. Oh, retire early, question mark. We're going to create a gross cash flow, not a net cash flow, both for Sherlock and Edith. We don't want to create a blank forecast. We want to create a cloned version from that current position that we've already got. So the moment I click on create, it does exactly that. Now I've got two. I've got my current position and my retire early. Again, they're carbon copies of one another. So all I can do, go back to my people and timelines. You'll see the timeline feature. I can add any event into my timeline and give it all the necessary information and save it. What that means is if I've got an event in the timeline, any time I'm adding in things like an expense, like an income, you'll see that it asks me for a start and an end date. And that end date can be tethered to an event, not necessarily an age, like a retirement event. So if I click on edit, you'll see this a little bit more clearly. So for example, for this salary, I want the salary to end when Sherlock retires. So the event is always listed at the top, all the events you have in here. I could have selected when he's 65, which is that option there. The problem is it's then stuck. So if the client ever wants to know what life would look like if they retire sooner or later, I would have to go into every single input and change it from 65 to 63 or 65 to 67. And you can see there's quite a few of these inputs I would have to change. So expenses have a start and end date, contributions do, so do withdrawals. In fact, pretty much everything in here, I suspect. The workplace pension, for example, also has an end date, which is going to be Sherlock's retirement and the cash-free lump sum, also a tax-free lump sum. So what you can do, because it's now tethered to something on the timeline, if I want to change this, all I need to do is go back to people and timeline, go and grab Sherlock, and then bring him back down to 63. So I can change the retirement date on the fly, and that changes my cash flow for me. So if I go back to my cash flow model, everything has been changed. Money in, money out, taxes, but more importantly to Sherlock is the savings over time. So we can see, look, Mr. and Mrs. Klein, if you do want to retire a couple of years early, I can now very quickly compare the two by just clicking that button up here. And now I can see side-by-side analysis. Look, again, you can get to the very end of your forecast. It's probably quite unlikely both of you are going to live to 100 and 103. But even if you were, you would still have assets left if you wanted to retire early. And we could do exactly the same for Edith now. What does life look like if you were both to retire early? So that's the benefit of inputs and timelines. Admittedly, that's exactly the same with the net modeler. Super useful feature to start tethering these different events to different inputs to different events. That then allows me to very quickly change and alter the logic. And again, if I ever wanted to delete a cash flow, it's just that little button and delete. So hopefully you found that useful. They are the core differences between our gross and our net modeler. As you can see, these are the core additions to the tax rates we have added. So any further questions, feel free to reach out to our help desk.